When we consider the US investment outlook, we have to very much start with what we think the outlook for inflation is likely to be. And when we consider this, there are three components of inflation that we're keeping a keen eye on. The first is the impact of commodity prices. The second is rental prices in the US. And the third is wage price inflation. Now, when we consider commodities, we have seen quite a significant pullback in commodity prices from most of their peaks. However, with China reopening, that could cause some upward pressure on commodity prices. Another thing that actually could drive commodity prices higher is we have recently seen OPEC and its allies slashing oil production, and that could ultimately also keep energy prices higher. So whilst we don't think that there's too much short-term pressure on the commodity side, we will keep an eye on those upward potential risks. Second of all, we're looking at rental prices. Now, this forms a component of shelter in the US. Rental prices have obviously been a lot higher as a result of a shortage of US housing stock, and also the fact that mortgage rates have risen so dramatically. So the 30-year fixed rate for US mortgages is now more than 6%, and it's risen very, very quickly as well. And that means that for first-time home buyers, housing is actually almost unaffordable, and which has, of course, created a lot more demand for rental properties. So we are seeing rental prices continuing to add upward pressure or keep inflation higher than we'd like. The last component that we need to keep a keen eye on is wage price inflation. Now, the US labor market is still incredibly tight. US unemployment is still at near historic lows. And of course, this puts upward pressure on wages. Now, given the fact that we are still seeing 1.7 job openings for every person who is actually looking for work in the US, in other words, more demand than there is supply, we don't think that pressure on wage prices is likely to dissipate anytime soon. So with those two last components, which are the stickier elements of inflation that we consider, still remaining above 5%, we do think that inflation is likely to remain stickier than the authorities would like. And that obviously has implications for what we think interest rates might do as well. But above all, we are obviously focusing our efforts on investing in businesses which we think will be resilient with that as a backdrop. Businesses which have pricing power, for instance, that are able to pass on rising costs in terms of their prices to their own customers. Businesses which are more defensive in nature and which are able to actually weather the storm in terms of the ups and downs of the economic cycle. But above all else, a pragmatic and level-headed approach continues to lead our way.